Hi everyone. I am actually trying to pivot a little bit and also have another playlist in my YouTube channel, something related to investing. And how I got into it, investing 101. So first thing is disclaimer, whatever I'm sharing here is my own personal opinion based on my experience and what I've learned. So why I'm doing this is I have a lot of people have kind of when I go around and we talk, I've heard a lot of people when they nobody has any idea how it works. And what I've learned from my past experience of all these years being in the industry in insurance finance, even though on the software side, and then also as a part of my college education from Drexel as an MBA, I learned a lot of stuff which I realized that it's like some of the basic stuff also a lot of people are hesitant about and they want to learn. And although we have ChatGPT these days, we have Grok, we have everything is available, but still a simple lesson I thought will be helpful for somebody who's really wanting to understand what is it, how, if I have money to save, do I just save it, or what do I do with it? How can I grow my money, in the sense that I just don't leave it in the bank. So what I wanted to start is a simple example. For example, there is someone who makes monthly $100, and I've done everything with the dollars in mine and the US, index and everything. But it's applicable to every. It should be applicable anywhere. So then if I rent or if I have a house which I have to mortgage, I will definitely be paying money towards it. And then I will have a lot of other bills which I just categorized into one, which is grocery and bills, which will be electricity, water, insurance, and everything. My car, gas, and everything. That, let's say, it takes 30. So this is like a normal. If we don't. If we are able to save at least $20 out of my 100, that should give us a good amount of money. So then I save these 20 bucks and I put it into my bank. So then by the end of the year, if I'm saving $20 per month, I will have a good $240, right? So that's a good amount which I can have in my account, right? And now what do I do with it? I can keep it just like that. So some countries and some banks, they're very good. They give very good interest rates. So then if you are happy with that and if it's at par with what you expect, to the growth be, then that's a very good thing. But a lot of places, especially in the US, I've seen the banks, the interest rates aren't that good at all. So then it makes someone think like, okay, what do I do? Do I need to do something with it, or I just cannot just leave it? Because if it sits in the bank, it will remain only that amount for like next couple of years, into $40 per year. So in 10 years I will have only 2,400 saved. So that's why, because I'm not my money just sitting there, it's not getting any interest, and I'm not making any money on that sitting money. So money should grow, money should be doing something while I'm also working, right? So then the next thing is, what do I do with it? So then I've thought I will talk about savings versus investing, right? So the first we talk about saving. Fine, I save money. There should always be some money that I should save. But then, so the bank will do interest. But then also there is something that is investing, which means it should grow. It depends on what you choose. It will grow a little bit or more, right? So saving is out of those $20, maybe just take 10 and put it in your savings, because that is something it's your emergency fund. If I need something today, I should have the money, right? But still, out of that 20, you take 10 out and then put it in somewhere where you can invest it. So one of the first option people think about is a fixed deposit or a certificate of deposit. It's time bound, so you can put it for 6 months or 1 year, and but your money is stuck there then. And also the risk is very low and the growth is probably like 4% or something. But you cannot, if you take it out, you have to pay penalty. But that is something basic a lot of people do. Even I did in my initial years. Other thing is mutual funds. This is something, then it gets a little bit complicated, and then we're like, okay, I don't know what this is, so we don't get into it. But basically these funds are run by fund managers, and then they will take your money and they will put it either in a combination of bond versus stock and money market. They're different type of funds. So for that, you will definitely need some kind of a financial advisor or an advice to use to put the money in there. But the growth is kind of based on right medium, because of the low or to medium risk, right? Because if you the more bonds it's safer, but the more stocks it gets risky. So it depends how where they put it. But then the return is also low to medium. And then there are also something called ETFs, which are called exchange traded fund. These are something which are based also, these are also run by various managers and very smart people who are good in what they're doing. And these are basically composed of some various assets or stocks or holdings. So for example, you can check Vanguard ETFs. They're very good, and then it will have all the details of what are the holdings, what is the performance. So the things to check is, okay, what are the holdings, means what are the companies where they have invest, where they're using, how does their portfolio look like. The portfolios look like 50 companies. And then how is their performance, so over the years, 10 years, how is the performance, should be 10%, right, or higher. So then that way it's good if you have that. And then so then that's why it increases the risk a little bit, but also it gives us more money. But these are also very popular. Also they are traded on a daily basis. They are like not like mutual funds, so that's why ETFs yield better, because somebody, they can, up and downs in the market, they can, if they keep trading it, buying and selling, then it gets better results. And finally the last is the index and the stocks, right? So uh, with directly putting your money in the index, the results can be higher. And there are different type of indexes like S&P, which is the popular, there are very good things about it. Like if you just Google up what is S&P index, it is basically a long term investment strategy, where you can monthly or yearly put some money in S&P. There is Nasdaq same, and there is Russell 200. So each of them you can go and check the what does it compose of, like what are the companies and how is the growth, and where is it going. So basically then you can invest in the S&P through ETF or through some other through your whoever is your provider. Like in US there is like E-Trade, and it's a very popular one. So we can just you can just pick and then see how the growth is, and then go from there. But the next thing is how what the last thing from what I've seen is the direct putting into stock, which is the highest risk. It's very risky, because if this it happens that if I put a money in one account in one company, and the company goes broke, then all my money goes down. So it's important to, if you directly are interested in learning about stocks, it's very important to use like a bucket, like they say, right? Don't put all your eggs in one basket, kind of. A lot of people actually think that putting all the eggs in one basket, if that basket is really strong, is better than others. But that is that's not like, that's something very risky, also very very risky. So it's important to just put everything where you have technology, versus you can pick something technology like Apple, Google, Amazon. They are the very top performers. Then Microsoft, of course. And then you can add some chips like AMD, Nvidia. And then we can have something like Chipotle, Kawa, which is like completely different industry. And then also we can have airlines like United, Delta, Southwest. Whenever it's go, then another thing is the cruises, right? RCL and Norwegian lines. If you check the performance and the growth of these, you can see like how they have grown in last 5 to 10 years, and then you can think about it. But this is something which is very risky. So some people who starting should never go directly, as well, I think. So initially it's important to slowly start, and then go into ETFs, and then start thinking about if you really have the if you really want to take that much risk, then the last thing is to put. So these are some of the basics that I want to share. So in the next something video, I'm just going to go in the detail of some of the ETFs and see and do the comparisons, and then show how to make a decision, because that's what I do. That's how I make decision. It's just my personal way of doing things, and I wanted to share because I think it's something very basic that we all if it will help other people. So that's my goal, to help you to understand. Thank you.